In this lesson, I want to describe to you the concept of management assertions. In our previous lesson, we talked about cycles. And cycles are simply a grouping of accounts that use similar processes within the organization. For instance, the sales cycle involves sales, receivables, and cash receipts. The acquisition cycle involves inventory, capital assets, accounts payable, and cash disbursements, and so on and so forth until all the accounts in the financial statements have been grouped within one or more cycles to which they relate. This little diagram shows how all of these cycles interrelate with one another. This is the first step, and we do this simply for audit efficiency so that we can audit like accounts simultaneously. Keep in mind that every journal entry has both a debit and a credit. So if you're able to substantiate either the debit or the credit, you are indirectly proving the other side of the entry. Does that make sense? But what exactly are we proving? Getting back to our income statement, we need to form an opinion on whether each and every one of these numbers is fairly presented. That means the amount is neither higher nor lower than what has been represented, and that management has got all the dollars recorded in the right account. Let's flip over to the balance sheet for a moment, because there are other things we need to substantiate here. Not only do we need to ensure that the numbers are appropriately valued, we also need to ensure that the company owns its assets and that it's obligated to pay its liabilities. Think of it this way. When management puts these statements in front of the auditors, management is asserting to us that these are the numbers and that they don't have a second set of books hidden away in the back of the closet. Management's assertions are multifaceted, and these can be dissected to help us focus our audit procedures. So let's take inventory, for example. What is management asserting about this balance? Well, first of all, management is asserting that the balance of inventory exists and that it's physically present. Secondly, management is asserting to us that it has the right to the inventory and that it hasn't been sold or owned or used by someone else, say in a contingent arrangement. This is called the rights and obligations assertion, or ownership assertion. Thirdly, management is asserting that all the inventory that it owns has been recorded and that there isn't another hotel storeroom full of unrecorded inventory somewhere in its operations. In other words, the balance is complete. Fourthly, management is asserting that the inventory balance was accurately measured, both in terms of quantities and prices and calculations that determine the carrying value. Fifthly, management has considered the appropriate valuation of inventory. As we know, GAAP requires inventory to be carried at the lesser of cost and net realizable value. So management's assertion is that they've made this determination for us by considering such things as obsolescence and ultimate selling prices. Sixthly, that the inventories have been appropriately classified as required by GAAP, say between raw materials, work in process, and finished goods. Other assertions exist for the detailed tie-in with the general ledger and the achievement of appropriate cutoff. A tie-in is a representation that the balance of inventory comes from the general ledger, and the general ledger is the foundation of the financial system. Cutoff speaks to ensuring that the transactions that occur near the period end date get reported in the proper year. For example, if you are a company that, say, ships on the last day of the year with the goods still in transit at the year-end date, and the title to the goods does not pass until the customer receives delivery, then management must have a means of determining how much inventory is in transit to ensure that this in-transit inventory is included in the inventory account on the balance sheet. So what do you think about the management assertions? Quite a lot to remember, huh? For the most part, assertions are intuitive. And when you get your hands on the inventory listing and you go to audit the inventory balance, you'll naturally seek out the evidence that addresses each of these management assertions. So without knowing anything about auditing, let's just see if we can figure this out a little bit. What would you do to validate the inventory balance that management is asserting to you? I'll pause and let you consider this for a moment. You could look at the inventory and see if it's actually there. That covers existence. and to a certain extent, the valuation and allocation assertions, as you can see the condition in the form of the inventory yourself. Did you think of getting a listing of the inventory and verifying it? Well, there's your accuracy assertion. If you agree what you saw to what is on your list, you may not realize it, but you've just verified completeness. So, do you see how these assertions can be evaluated by performing these sorts of audit procedures? Of course, we will talk about this in a lot more detail in later lessons as we get deeper and deeper into the audit. We've talked a lot about the assertions for the balance sheet accounts. Let's spend a moment comparing the balance sheet assertions to the other accounts, which you should know are the income statement accounts. I've got some good news for you here because the assertions are very similar. Instead of existence, you have occurrence. So you have to verify that the transaction reported actually happened. Let's take an expense like payroll. How could we verify the payroll expense was actually incurred? Hit the pause button and think about this for a moment, and when you think you have an answer, press play to continue. We first could look at how the employees were paid. We could look for evidence that the employees performed the work by looking at their time cards. We could check how much these employees were paid by looking at their wage rate or salary in their personnel files. All of these things would help us verify that the payroll expense reported actually occurred. Now, completeness is the opposite. That is to ensure that all transactions have been reported. We are also concerned with similar measurement assertions. For instance, accuracy. The amounts recorded were calculated correctly. Classification. That is, the transactions have been recorded in the right accounts. And posting and summation, which is really the same thing as the detailed tie-in we spoke of earlier. The allocation assertion is called timing, but don't be fooled, this is the same thing as the cutoff assertion we discussed earlier. That covers the accounts on the trial balance, but we also need to consider the other disclosures in our financial statements as well. After all, our audit opinion extends to this information as well. As this information is largely an extension of the information presented in the financial statements, you might expect that the same assertions are relevant. So, for example, consider related party transactions. GAAP requires separate disclosure of these sorts of activities because they may or may not be transacted at fair value. So the relevant assertions are once again verifying the related party transactions to determine whether they are occurred, ensuring that all the related party transactions have been reported, which is completeness, verifying the rights and obligations associated with any related party assets or liabilities, ensuring the transactions were accurately reported and appropriately classified and can be well understood by the users. Understandability is the only real new assertion in this list, and in principle it makes sense given the nature of the narrative note disclosure. So there you have it, the so-called management assertions. While I try to desperately oversimplify things for you, I'm sure more than a few of you are doing the math in your head, and you're thinking to yourself, if I have 6 cycles composed of thousands of accounts, and let's say 8 assertions, holy crap, I'm going to be auditing forever. All is not as dire as it may seem on the surface, and for a couple of reasons. First of all, keep in mind that many audit procedures cover off more than one audit assertion, as we'll see later. Second, we use a risk-based approach to designing our audit procedures. Not all the assertions are relevant or of sufficiently high risk to warrant the same level of attention. And third, the audit programs are well designed to cover off the assertions. You as an auditor do not need to dream up the procedures to cover off all the assertions. This will be done for you in the audit software that you use. However, it's still good that you understand the notion of assertions because we will refer to them often, and you still need to be able to identify which ones pose a higher risk so that you can tailor the audit programs to address those specific risks. So that's all for this lesson. Until next time, don't stop till you get to the top. When you get to the top, don't stop.